Are you on track for retirement? It sounds like a simple question, but for millions of people, it triggers a quiet and deep-seated anxiety. And here's a startling truth that explains why. The average person's retirement savings are dangerously behind. According to the Federal Reserve's data, the median retirement savings for a household aged from 55 to 64 is only around $185,000. For many people, that's a terrifying small number to fund a 20 to 30-year retirement. The gap between where most people are and where they need to be feels more like a canyon. And this is the silent stress that keeps people up at night, wondering if they'll ever be able to stop working. But what if you had a clear, decade by decade roadmap? Not vague advice like save more, but specific financial milestones to hit in your 20s, 30s, 40s, 50s, and beyond. That's exactly what we're doing here today. If you're ready to replace uncertainty with a clear plan, then you're in the right place. And if you find this kind of straightforward financial guidance helpful, hit like and as well subscribe. It really helps the channel. And for you doing that, here's a cute picture of my pups, Roman, Dice, Toby, and Angel. Before we go decade by decade, we need to talk about the single most powerful force in your financial life: compound interest. Albert Einstein called it the eighth wonder of the world because it does the heavy lifting if you give it one thing: time. Think of it like a snowball rolling downhill. It starts small, but as it rolls and rolls, it picks up more snow and more traction, and once it's big enough, it grows faster and faster and it gets bigger. That's compounding. Let's make this real. Imagine two friends, Anna and Ben. Anna starts investing $300 a month at age 25. She does this for 10 years and stops completely at 35. She invested $36,000 in total. Ben waits until 35 to start. To make up for lost time, he invests $300 a month for 30 years until age 65. Ben invested $108,000, 3 times more money. Who wins here? At an assumed 8% average annual return, Anna actually ends up with about $551,000. Ben, on the other hand, ends up with about $447,000. Anna invested a third of the money, but still ends up with more. And that's the power of time. Every year that you delay investing robs your future self of the most explosive growth years. This is why the milestones you start in your 20s matter so much. Your 20s are not about becoming rich. They're about building habits. The discipline you develop here becomes the foundation your entire financial life is built on. Before investing aggressively, build a 3 to 6 month emergency fund, covering essential expenses only. This fund prevents a job loss, car repair, medical bill from turning into credit card debt. Keep it in a high-yield savings account, accessible but separate from your daily checking. High interest debt is compounding in reverse. If you're paying 18 to 25% on credit cards, earning 8% in the market doesn't help. You can't out-earn high interest debt. List debts by interest rate and attack the highest first, or you start with the lowest balance and work your way up and build up the momentum using the debt snowball. Once debt is controlled, begin investing. Your long-term target is 15% of your income. The order of this matters: 401k match, Roth IRA, back to 401k, and automate everything. The big goal for your 20s, by age 30, aim to have about 1 time your annual income saved. The median retirement balance for people under 35 is under $20,000. If you're anywhere near this goal, you're ahead of most people. Your 30s are where income grows, and so do the expenses. This decade is where people either build wealth or get stuck. This is also the decade where a lot of people buy their first home. Historical data shows that younger buyers ages 25 to 34 once made a significant portion of first-time home buyers, but now the composition has shifted. About 32% of first-time buyers were aged 25 to 34, while many are now older, closer to 40s. According to Realtor.com, only about 33% of 30-year-olds in the US own a home today, down from the 47% in the mid-1980s. This illustrates that far few people achieve home ownership in their early 30s compared to those with the past generations. If you're able to do this in this decade, you're going to be ahead of a lot of people. Increase savings to 20%. The easiest method is saving your raises. Automatically invest a portion of every raise before lifestyle absorbs it. Car loans, student loans, credit cards. Your goal, the only debt being the mortgage by age 40. If anyone depends on your income outside of your savings, you should have term life insurance and a basic will. By age 40, aim for 3 times your income saved. This decade separates wealth builders from everyone else. Your 40s are often peak earning years. This is where optimization matters. Even if you can't contribute max, consistency is critical here. Housing is usually the biggest retirement expense. Maybe start looking at how you can start paying off your mortgage so you can have a free and clear property. Even if it's a couple $100s extra a month towards principal only, or doing a bi-weekly payments so this way you have 1 month extra each year. Whatever you can do to help speed up the process, as housing is the biggest retirement expense, and this time is your peak earning years. A fee-only advisor can identify blind spots. By age 50, aim for 5 to 6 times your income saved. This is the red zone, which means if you're making smart moves here, you can change the entire trajectory of your retirement. But it's also the decade where consequences from earlier decisions become very real. You're not just saving anymore, you're testing your retirement plan, locking in protection, and optimizing every dollar you can before you stop working. Once you hit 50, the IRS gives you a huge advantage: catch-up contribution limits. Use the extra contribution limits aggressively. For example, 2026 IRS limits, 401k, $24,500 is the regular limit, plus the $8,000 catch-up IRA. So $7,500 regular plus $1,100 catch-up. This can turbocharge your savings late in the game. What this means in real dollars, let's say you're 55 with a $200,000 income, adding these extra contributions could be $10,000 plus more per year going into tax advantage accounts. Over 5 years, that difference compounds significantly. Start this decade by maxing allowed contributions before you invest anywhere else. You wouldn't buy a car without a test drive, right? So don't retire without a financial trial run. Here's what that looks like. Plan a retirement budget that includes housing, food, healthcare, travel, and hobbies, and miscellaneous items. Live on that exact budget for 3 to 6 months while still working. This reveals blind spots that spreadsheets miss. Things like a lower discretionary budget than expected, higher insurance costs, travel lifestyle reality versus expectations, and minor costs that can quietly add up over time. You might discover you need to save more, adjust spending, or rethink how you want to spend your retirement. Healthcare is one of the biggest and most unpredictable costs in retirement, yet most people ignore it until it's too late. If you have access to a health savings account, HSA, this is gold. HSA advantages, there's triple tax benefits. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. This is arguably the best retirement account, especially for healthcare costs. And if you're in your 50s, start maximizing HSA contributions, begin researching costs for premiums, prescriptions, vision, dental, long-term care, etc. Don't assume Medicare or supplemental plans will be cheap. Investigate now. This isn't optional, it's necessary. At a minimum, you need a last will and testament, a durable power of attorney for finances, an advanced healthcare directive, trusts if your situation warrants, and this protects your legacy and spares your family from painful legal decisions during stressful times. Not even accounting for the fees that comes involved with having the government handle probate or anything like that. Big goal for your 50s, by age 60, aim for 8 times your annual salary saved. This is less a hard rule and more of a comfort zone target, because hitting this gives you flexibility with lifestyle choices, early retirement timing, market downturn resilience. If you're behind, that's okay, because we'll talk about targeted catch-up strategies next. Your 60s are not about withdrawing. They're about planning income streams, optimizing benefits, and ensuring stability for the decades ahead. This is a mindset shift from accumulation to distribution strategy. You've spent decades building your nest egg. Now you need a smart distribution plan, one that gives you income but does not deplete resources too quickly. A popular guideline is the 4% rule. Withdraw about 4% of your portfolio in the year one. Then adjust for inflation each year after. But retirement planning today is more flexible. Reduce withdrawals in down markets, increase in up markets, adjust based on lifestyle if you're traveling or have a lot of hobbies. The key is to write it down before you stop working. When you claim Social Security as one of the most impactful decisions for lifetime income, here's how it works. You can start as early as 62, but your monthly check is permanently reduced. Your full retirement age, FRA, is typically around 67 for most people. Delaying benefits past the full retirement age up to age 70 increases payments by about 8% per year. Delaying Social Security gives you a guaranteed inflation-adjusted boost, which can be a form of longevity insurance. Deciding when to claim depends on your health, your life expectancy, your other income streams, your financial goals. In your 60s, it's time to shift from growth to stability and income. This often means increasing exposure to bonds, adding dividend-paying stocks, using annuities or guaranteed income products if appropriate. A common rule of thumb is to hold a large portion in safer assets, such as 40 to 60% bonds, fixed income, 40 to 60% equities for growth. This reduces volatility and it ensures that you don't have to sell stocks at a loss when you need income. The IRS won't let certain tax-deferred accounts grow forever. Starting at age 73, you're required to take out a certain percentage of your tax-deferred retirement accounts each year and pay income tax on it. Typically starts at age 73. Important points. RMDs apply to traditional 401ks, IRAs. Roth IRAs do not require RMDs for the owners. Taking RMDs late or incorrectly can trigger penalties. Planning ahead can help you manage your tax bracket in retirement. Big goals for your 60s. By your target retirement age, often mid-60s to 67, aim for approximately 8 to 10 times your final salary saved. This, combined with smart Social Security timing and a thoughtful withdrawal plan, gives you the best chance at a retirement where you don't run out of money, even in a long life. If this stressed you out, hear this. You're not alone and you're not stuck. Here are 3 moves that work. 1, increase savings 1% every 6 months. 2, save 50% of raises. 3, work 2 to 3 more years, helps out a lot. This isn't about perfection, it's about having a map. 1 decade at a time, 1 milestone at a time. What decade are you in? Drop it in the comments below.